Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 5th of May. I'm Daniel Lam, your host for the podcast. I'm back from participating in the World Chess Cup qualifier in Mongolia. Now, of course, during my absence, I've still been following the markets. There has been some mild recovery in global equities, as investors believed that Trump would be concentrating upon making trade deals, especially with his key partners such as Japan, India, and Korea, over his second 100 days in the office. There's also a rising chance that high tariffs on China are to be reduced, and there will be trade talks starting this summer as trade uncertainties hurts U.S. growth and lifts inflation. Now, Trump's approval rating has also been falling, and there are signs of a growth slowdown. These are factors that may act as a check and balance and leading to a softening stance on trade. Now, Trump is likely to be mindful that the approval ratings do not fall further, and growth slowdown does not lead to a deep recession. The growth slowdown is linked to policy uncertainties, which has started to hurt business and consumer confidence. In fact, in the current U.S. earnings season, a number of companies have pulled full-year earnings guidance due to policy uncertainties. This is despite the fact that almost 74% of the S&P 500 companies that have reported so far has been beating estimates. This uncertainty is leading to extremely light investor positioning in U.S. equities. Now, in normal circumstance, this would be a very positive contrarian indicator for investors. But there is a risk of slowdown in the U.S. economy, shown by both U.S. consumer confidence and job opening rate falling to the lowest level since the COVID pandemic. Now, non-farm payroll, while beating expectations, is on a slow downtrend. And of course, that number is not yet taking into account of the effect from Liberation Day. So therefore, we would be trimming any excessive sizes in U.S. equities on further rebound, especially if S&P 500 moves above the 5,800 level. We would take this opportunity to be switching into high quality bonds and Europe and China equities, where policy support is likely to be helping growth and corporate earnings. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.